For those who don't know, Henry is, people talk about pioneers in different industries a lot. It's a word that gets thrown around. Henry definitely deserves it. He co-founded KKR, Kohlberg, Kravis, Robertson Company, back in 1976, still co-CEO with his cousin George Roberts. And Henry, so let's get to the really important stuff first, which is 2 weeks ago, Donald Trump said you would make a really good Treasury Secretary for him. He also said Carl Icahn and Jack Welch. Icahn says it's too early in the morning. Welch didn't comment. Do you want the job if there's a President Trump?
That was scary when he said that.
So is that a no, or is that an I'll think about it in the administration?
We'll leave it. That was scary.
Fair enough, fair enough. Henry, what I want to start, a lot of this conference is going to talk about disruption, technological disruption in established industries. You think Airbnb and hotels, or Ubers and taxis, industries that weren't considered tech industries originally. KKR's history, even though you also invest in tech, is a lot of these different industries. You invest in energy, you invest in retail, industrial, along the lines. When you're looking at a prospective deal, how do you try to look at the disruption that's coming from down below to make sure that you're, say, not buying a taxi company 4 years ago that's going to get absolutely destroyed?
Right. Well, one of the things that I always like to ask the team to put in their presentation to our investment committee is what can go wrong? What disruptor is out there that can make this company either obsolete or change its operations dramatically? So the way we go about it is we have a number of senior advisors, first of all. So we've got people like Shantanu Narayan from Adobe. We've got the CEO of Shazam. We have the CEO of Shutterfly. We have others that are advisors to KKR, number one. Number two, we've got an office, and a very important office, where George Roberts and others are, and our whole tech group is out of Menlo Park, so we're there. I spend a fair amount of time out there personally because I think it's really important. And so you can't go into any of these businesses, any investment, anywhere in the world today and assume that things are going to be the same. At the Business Council a few months ago, John Chambers and I were on a panel together, and he said to the audience, which are all these large companies' CEOs, he said that I'm willing to make a bet that in 10 years, 40% of your companies won't be here. And he went on to say that he said they no longer put together 5-year plans because they're obsolete after a year or two, so they've moved now to 1- and 2-year plans. Well, we're the same way. We look at a company and we say, more importantly, what could this company become if we were able to add technology, if we were able to partner with another company? So, for example, one of the things that I like to encourage young companies to do is think about companies like KKR with a vast portfolio of companies that we have. We've got over 100 companies in a lot of different industries. We have over $220 billion in revenue. And if you think about, can you start to scale your business much faster by tying in with somebody like a KKR that has this, let's call it for now, the offline kind of business? The answer is yes. So an example of that would be First Data. A company called Clover was started in the Valley. It's an Android point-of-sale tablet company, terrific software. And we said, why don't you come and be part of First Data, which we own? And that made a lot of sense to them because here overnight they had 6 million customers where they could start to roll this out. So
and they just rolled out a mini one, right? Mini mobile one just the other day.
They started with a larger one, and now they have gone to they went to mid-size, and now they've gone to a very small one as well.
You brought up First Data. Let me ask, First Data is, and I think I'm correct in saying this, is the largest single equity investment KKR's got right now in terms of amount of cash KKR's put in. You invested originally and then kind of doubled down last summer. I'm wondering, when we spoke last summer about it, when you made the investment, I asked about a possible IPO, bringing it back to the public markets. You said, not yet, we're worrying about other things. It's been a year, you've gotten some other things done. Is that on the horizon?
Well, all I'll say is stay tuned. You know, these things all
Should I
change.
stay tuned, next year? Should I stay tuned in 2 years? There's a lot on the TV, and I don't know what to.
Just stay tuned, Dan. And, you might be surprised what you're going to learn.
Fair enough.
So,
fair enough.
no, the company's doing fine.
KKR has some, like First Data, has some big tech companies that you guys have done kind of as traditional KKR deals, leverage buyouts, traditional private equity deals. But you also lately have done a bunch of growth equity investing in the tech space. I'm looking at my list here: Sonos, Vitalia, FanDuel, some in biotech as well. So I guess my first question is, why are you dipping down, and are you concerned at all? You guys didn't, but back in '99, 2000, some big buyout firms started doing quasi-venture deals, and it didn't go well for them.
Well, let's first start with the fact that private equity today has changed dramatically. Most people think of private equity as you go in and you buy 100% of the company and you lever it up, and hopefully in 5 years you paid off enough debt, the company's growing somewhat, and you make some money. Today, private equity is a totally different business. Today, private equity firms like us will invest up and down the capital structure. We're not focused just on buying companies, but we want to be a solutions provider, and we are a solutions provider to lots of different kinds of companies. So that's on one hand. On the other hand, let's look back to the period 1999-2000 that you mentioned, which is a time when there was a tech bubble. It was the internet bubble at that time. And many of you were around then, many of you were probably involved with it or were investing, but my own experience was I'd come out to the Valley, I'd spend time talking to these people, and I said, tell me your business plan. And their business plan was very interesting. Their business plan was to go public. And I said, that's not a business plan. That is a means to raise some capital. Give me your business plan. Well, Mr. Kravis, you don't get it. You don't understand. He said, it's all about eyeballs. And I said, well, I don't get it because I don't understand how you turn eyeballs into cash flow and so forth. That's what blew up. Fast forward 15 years, we have a totally different environment today. Number one, technology has changed for the better tremendously in the last 15 years. Number two, the teams that are running these businesses, and by the way, most of these businesses today that are young companies, they're real companies. They're real
Not
companies.
cash flow positive usually.
Not cash flow positive. Most of them are not cash flow positive, but they're real business with real business plans, with a mission statement. They're hiring terrific people, and they're able to build a good business. Now, if we're talking about valuations, that's a different subject.
Well, I wonder, do you think, and it's hard to say because I know they're your deals and you think they're good deals because they're yours and none of them have blown up yet, but do you think on the whole that these deals are going for too high a price? Yours, TPG's, everybody else is in that kind of growth equity space?
Well, first of all, we're a minor player in this space. TPG and other private equity firms are really minor players in the scheme of things. We typically will invest in some of these technology or technology-related companies in the C, D round. They're more growth equity. They're starting to show sales. They're ramping up. And what I like to say to people, you can raise money anywhere. There's money everywhere today, whether it's from venture capital firms, from hedge funds, from private equity firms, all the way up to the Fidelities and T. Rowe Price today. And that is in part what has driven these valuations. You've gotten, nobody would have thought 3 years ago that the T. Rowe Prices and the Wellingtons and Fidelities of the world would be playing in that space, but they are because they've got plenty of capital. Interest rates are very, very low. And as a result, they are perpetuating this valuation.
I'm curious, a question I'd like to ask folks, and this is without doing any due diligence on them, but I think there's 100 or so of these so-called unicorn companies, these billion-dollar-plus privately held tech companies. If you were to put them in a bucket at their current prices or where they were last round, would you personally invest in it as a weird index? Would you buy it?
Well, what's really hard, I can't tell you, and I don't think anybody can tell you, who the winners and the losers will be in each industry. What strikes me, though, as I look at these and I say, well, what you're pricing these on, you're pricing them in large part on that one or two or three of these are going to be winners. I don't buy the fact that there necessarily will be three winners at the prices that you're valuing the companies. There'll be one winner, who knows what it is. So let's assume you've got something at $1 billion today, no cash flow from it really, a concept, it's a great concept, it can scale, but you've got three of these people. There's probably more downside than there is upside there, but one of them will probably be a winner because the industries in which most of them operate in are scalable industries.
There's been talk about KKR raising a specific tech kind of growth equity fund. You guys are currently making most of these deals off your balance sheet. Mm-hmm. Is that going to happen? Is that fund coming?
We have nothing on the horizon right now. We've got a fairly large balance sheet, which is different than most private equity firms, and we have a different model. Our model and the way we went public, as I think you know, Dan, was to take KKR, the partnership, and merge that into a company that was already public, traded on the Amsterdam Exchange, which we had started, which was an investor, like a limited partner in all of the investments that we made at KKR. So we knew what these companies they've invested in. We also managed that money, that pool of capital, and we had gone public at $25 a share with KKR private equity investors, and it was trading down to $2 a share. It was during the crisis. We said, let's take KKR and merge that into KPE, and what we'll have is a balance sheet. And that balance sheet, what that gave us was a $5 billion in round number balance sheet in our own companies. So what we've been able to do with that balance sheet is buy some other companies by having the stock. It's a way for us to put money in and raise additional capital to put our own seed capital in. And the big difference is if you have a fund, you typically are going to get 20% of the profits, whereas it's our own money, it's our balance sheet, or the shareholders' money, I should say, we own 100% of it.
Can I ask a private equity nerdery question here, which is, if you've got your tech team, your folks in Menlo Park, spending some of their time sourcing deals that are going to be invested off of KKR's balance sheet as opposed to the fund, the main fund, if I'm a limited partner in the fund, am I annoyed that I'm paying kind of helping to pay their salaries to make investments that I'm never going to get a piece of?
No, because that's not what our funds are set up for. If our funds were set up, if it's large enough, it goes into a fund. The fund comes first, way before the balance sheet. Any co-investments where they're actually paying us fee, they come ahead of the balance sheet. Balance sheet's the last place that it will go.
You talked about your IPO. You guys went public at this point about 5 years ago, right? At this point, about 5
years ago. Yes.
5.5. There's a lot of companies today, including some folks probably who are in this room, who have very successful private companies that don't want to take them public. I think the word would be scared of doing it and becoming a public company CEO. You've obviously been in the markets for a while. You had been on the boards of lots of public companies, brought companies public, taken them private. But I'm curious, did you learn anything? Did anything surprise you when you went from running a successful privately held company to becoming a publicly traded CEO?
You know, most people say, why did you go public? Well, we went public because it gave us permanent capital. It gave us a large pool of capital that we wouldn't have otherwise. And that's been really critical because it's enabled us to start a number of new business. Very hard to go out and raise a first-time fund. I don't care who you are or what your record might be. If it's a first-time fund, it's difficult. So this way, we've been able to use the balance sheet and the money we got as a result of going public and seeding our real estate business, seeding our oil and gas business, using it for our growth equity that we've just been talking about. So it's given us a real advantage, we feel, to continue to grow the business. Now, I'm not unhappy one bit that we went public there. And I say to people, look, if you think that we're going to be able to tell you at KKR what our earnings will be next quarter, it's impossible for us because we have to mark to market every quarter. We're buying different things, we're selling different things, we're going into different businesses, et cetera. Very hard to do. So we say you want to own our stock. It's a pretty good investment, a way to participate in all phases of private equity. And it's a way for you also to look at private equity on a long-term basis. Most people forget, Dan, that private equity is really a long-term game. This is not a hedge fund. We're not in the hedge fund business. We're not.
A lot of your rivals are in the hedge fund business.
Yeah, we don't have a hedge fund at KKR. We have a fund of funds which invest in different hedge funds, but KKR itself is not in the hedge fund business. So our average holding period, and it would be true whether it's in growth capital or whether it's in private equity, is 7.5 years. So we just look at things totally differently than most companies do.
Do you think, are the fear, and as you said, you have a different kind of company, obviously had a much longer track record, had been around, 30 years before you guys went public, or
right.
Over that.
Yep, 34 years.
Do you think that the concerns of privately held tech CEOs about going public, are those legitimate concerns, or do you think those are jitters folks should just get over?
Look, I'm not going to tell any company they should go public. If they have a reason to go public and they need to raise capital and it's a way for them to raise capital, or they want the stock to use to be able to buy other companies, if you've got a good company, you can continue in the environment we're in, you can raise a lot of money, as all of you know. So you don't have to go public. I would tell most companies, wait until you have to go public, because then you don't have the scrutiny of the quarter-to-quarter earnings. I think the worst thing to happen to corporate America are quarterly earnings, because you end up making a lot of very short-term decisions when in reality you should be making long-term decisions.
I'm curious, how much of a technologist do you think you are? And I don't mean somebody who's sitting there coding all day, but in other words, I'm trying to get a sense for you. I've been told by folks who work for you that you're very, even on kind of growth equity investments, very hands-on. I guess I'll ask it this way. Do you ever play on Twitter? Do you ever go on Facebook? Something like FanDuel you guys invested in, do you have a FanDuel account? Have you been betting on games?
I don't have any of those, but and I love all that. I love the gadgets, and I buy them all and use them. And do I have a Facebook account? I do. I'm not on it. Do I have a Twitter account? Yes, I'm not on it. But
so
I have
like a lot of Twitter users.
But I have it, and I really do care. And I don't think the CEO of any company, if they're going to be putting money to work, can't be putting a lot of money to work without at least knowing the fundamentals of it. I'm not a technologist by any stretch.
You invest with Iconic, which is kind of the quasi-family office. Basically, they make a lot of tech investments in the Valley. Can you just tell me that relationship? Why do you personally have a relationship there? Why is that important for you?
Well, number one, it gives me a very good overview of what's happening in the Valley there, and that's really important, not only in the Valley, in other parts of the states. And Devesh Makan, who's a friend of mine who runs it, he helps me in a number of ways. He helps KKR in a number of ways, and vice versa, we help him. So I spend time with their people, for example, talking about culture and how important culture is at KKR, and how we set our culture to, on day one, 39 years ago, and encouraging him to think about it. They have an unbelievable network, which we can then plug into. I'm on an advisory board that he has, which doesn't, quite frankly, I've only, they meet once a year, so I missed the last meeting, so that's how involved that I've sort of been. But I see Devesh a lot, I talk to him a lot, I talk to his people a lot. And it's really it's a window on technology for us.
You talked about culture. When you're looking at a company and you're doing due diligence, whether it's a tech company or anything else, you can look at the financials, and you can look at the projections, and you can look at the product, and you can talk to customers, and you can do all that. You just mentioned culture. So this is a kind of vague question, but so take it where you will. How do you get a sense of if the culture at that company is one that is going to help the company continue to grow in a positive way, or if there's some serious trouble spots that you can't see when you're just looking through the books?
Well, it's going to be true at any company. It doesn't matter whether it's a long-established company. I've been doing this since 1969, first through Bear Stearns, and when we started the private equity industry, or it wasn't even an industry, it was private equity investing became an industry, and what I've continued to do. So you can read people. You get to read them. You find out, for example, if you take a walkthrough a plant with the CEO of the company, you find out whether there's a labor issue in the company just by the mere fact that there's no one's talking to the CEO. I can go through plants and everybody's saying, "Hi, how are you?" and he's knowing the people by name. It makes a huge difference. I tell our people, get out of the office, get out from behind the computer, because the computer is not going to tell you everything you need to know. The only way you're going to find out what you need to know is go out there and really walk the aisles of the business. So our culture is one of inclusiveness, very important. And the thing that when we started KKR, George Roberts, my cousin and my partner in this effort, and Jerry Kohlberg, and I sat down and said, we do not want to have a culture like we had at Bear Stearns, where we came from. And that culture at Bear Stearns was very much an eat what you kill. People were only paid on what they produced, period. And so literally I would lock, and I was a partner at the firm, I literally would lock my door at night and lock my desk. And we said, look, that's not us, that's not what we want. So we set up a culture on day one, and I would tell any young company, whatever it is, define your culture as soon as you possibly can, because otherwise your operations will define you, and that will define your culture. Grab hold of it, make the culture whatever it is. In our case, it's very much one of inclusion. Everyone at the firm is paid on every single transaction that we do, whether you worked on it or you didn't work on it, whether you're operating out of Australia, you're operating in Menlo Park.
I'm curious, when you say that, how you say investment staff or all the way down the board to everybody?
It's the investment staff particularly, but every single person at KKR, when we went public, George and I, because the two of us owned 100% of the firm, we wanted to make sure that every single person at KKR was an owner of KKR.
Are you surprised you guys outlasted Bear Stearns?
That what?
That you outlasted Bear Stearns?
No, I mean, I didn't really think about it too much. I just knew what we wanted to do and what was right for us. It's a sad day for Bear Stearns. You know, they should never have gotten themselves into that position. But it's a different culture. It's a different kind of firm. That was a trading firm. Our view was totally different. And our view about culture is, here's what we do. And I would say this for any young company to think about. One of the most important things we do is how do we evaluate people twice a year. We evaluate them at midterm and we evaluate them at the end of the year. And we evaluate them in three buckets. One is management and leadership, two is commercial success, and three is culture and values. And we've had people at the firm that have been great commercial success for us, and yet they never became a partner because they did not fit into the firm. Now, so we do a 360 review, the written ones are for the birds, quite honestly. Everybody loves everybody and those things. So we do the 360 reviews in person for the top 85 to 100 people. And it's amazing what you'll find when you start talking to somebody and doing the review of those people. And it shouldn't be the person that that you're the boss, that works for you. Somebody else in the firm will do the review. So we evaluate people in those three buckets that I just talked about. And then what we do is we get together as the management committee. We go through the report of the person that did the report plus the boss, and then we vote. And we vote by closed, those handheld things, and we rate people. And that's how people are evaluated at the firm. And I can't urge you enough to think about something like this. It works. It helps you with your culture. It helps you evaluate your people, because as fast as the technology firms are growing, you're going to be making mistakes as you're hiring people.
We've got time for a couple questions, and while if you have one, raise your hand. A person with a mic will come. But Henry, I'll ask you a quick yes/no. 2 years ago at this conference, the Dell buyout basically began, and then last year at this conference, it's essentially closed. We haven't seen a $10 billion plus tech buyout since. So just yes/no. In the next 12 months, will we?
I think you might, and the only reason I say you might is there's certainly opportunities out there, and there's plenty of capital. What has changed since the Dell deal was done is that the regulators have clamped down on the banks and basically said, we don't want you lending more than 6 times debt to EBITDA. And that really does start to crimp what the banks will do. So that will be the limiting factor. How much equity is there out there?
Okay, fair enough. Do we have any questions? Do we not have any questions? If not, I've got more. So then, never mind. Oh yeah, we do.
Right over there.
Yep.
As you were saying, Mr. Kravis, you've been around for a very long time. You pay scrupulous attention to the fundamentals, but you've moved into a tech market. There's a lot of volatility. You've had companies go from 5-year plans to 1-year plans. Over the past 25 years, what's the one fundamental insight you've had to abandon when you began your career that makes you successful today? What have you had to give up believing to be more successful today when you invest?
I'll tell you the one thing that we made mistakes on for a long time is we waited too long to change the CEO out. Earlier days for KKR, we always believed that you could change a CEO, that a CEO would become materially better than what you saw. I can say almost categorically that what you see is what you get if you've got reasonable judgment, you're asking the right questions. Very hard to change a CEO materially. You can help them around the edges. However, what we found when you do change a CEO, a lot of the people below them just blossom, and they're fantastic. And yet they were smothered because you had the wrong CEO. They never blossom, or you lose them. They eventually move on. They want to go somewhere else. So I'd say the one thing that I learned mostly is move much more quickly. If you in your gut, and after doing some real thought and research on the person running the business, you don't think that person is the right person, move quickly and make a change.
Henry, I really want to thank you for doing this today. Appreciate it.
Thanks a lot.
Thank you very much.
Thanks. Nice to see you. Whoa.